Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the stock market and most importantly on consumer sentiment. Right? Consumer sentiment is an indicator from the University of Michigan that has been indicating an extremely low, in fact, a record low sentiment amongst the consumer. We've typically seen this level of consumer sentiment around recessions, right? You can see consumer sentiment drops leading up to a recession and stays low throughout the recession. It only recovers after the recession is over and done with, and we've seen that over and over again. Low consumer sentiment coincides with a recession. It happened in the Great Financial Crisis. The only place where it didn't happen was in 2011 right here, where it's pretty low without triggering a recession, but just after the 2008 financial crisis. And today, of course, we have one of the lowest readings in history. So what does this mean? All of these readings have triggered recessions. All of these readings have coincided with recessions, but they've also coincided with some of the best buying opportunities in the stock market ever, right? We just take a look at the last three low readings in consumer sentiment. We have 2011, 2008, and 1990, which of course have been some of the greatest buying opportunities in history in the stock market, right? We have 2008, of course, 2011 right here, and going back a little bit further, we have 1990 right here. So the question is, should we take this reading at face value, expect a recession and a massive crash in the market, or should we be contrarian about this and actually consider that this is a rare opportunity to take advantage of widespread pessimism amongst the population? That's exactly the question that we are going to answer in this episode. If you enjoy these kinds of episodes, make sure to click on that like button if you appreciate the effort and the time that goes into putting these videos together. Also, don't forget to subscribe to the channel if you are new here and you're interested in following these crazy markets with us. And now, without further ado, let's get right into it. All right, so the first chart that I want to take a look at here is the chart of the probability of losing your job in the next 5 years. Now, this is a survey, right? So similar to the consumer sentiment where they ask people's opinion about their financial situation and what they expect to happen in the future. The same thing goes for this chart here of whether or not people expect that they're going to be losing their job anytime soon. And you can see that is currently at a record low here. It's very strange to see that people are so optimistic on their job positions and yet so pessimistic on how they view their financial situation. Because for people to be optimistic on their job, it means they're seeing their company do well. It doesn't suggest that they're currently seeing their company struggle to profit, struggle to keep their head above the water, which would end up leading to layoffs. So this is definitely a very, very strange thing that's happening with consumer sentiment being so low and people being optimistic on the job market. That hasn't happened that many times in history. In fact, we can actually take a look at that by putting the Michigan Consumer Sentiment Index on top of initial jobless claims and see the correlation. You can see initial jobless claims have been moving down here, while consumer sentiment has also been moving down. And if you take a look at this indicator that shows you the correlation, the trend correlation between the sentiment and jobless claims, it's positive here, meaning that we're seeing both of them move in the same direction, which is down. And if we take a look at other moments in history where we've seen a positive correlation like this, it's only happened a handful of times. It happened once in 1979 right here. It happened once in 1987 right here. Once in 2005 right here. And once in 2011 also right here. Now, if we take a look at the stock market in each of those instances, stocks performed well in the months ahead, at least 6 to 12 months. Stocks performed well. This is the bottom of 1987, right after the big flash crash in 1987. And in 1980, and I'm sorry if this chart is getting a little bit messy, but here in 1980, That was right before a major run on US equities. This is perhaps early evidence that when consumer sentiment is dropping without seeing a weakening job market, perhaps it's a false signal. And another chart that's very relevant to this, and we took a look at that a few times already, but it's the real spending on goods, so how much consumers are spending versus the initial jobless claims. And you can see both of them are moving down. That never happens. So this is a very special situation. A lot of what's going on here has been just rebalancing after COVID. There was a reopening, good spending surged, you had a massive spike in inflation that followed, and so spending collapsed. But the labor market, so the red line, continued to move down, and you didn't see that typical rise in unemployment that you see with a decline in good spending. So this is definitely a very different dynamic. So if the job market is so strong, why is the consumer sentiment low? Why are people so pessimistic? And it really all comes down to inflation, right? If we put inflation, so CPI, on top of this chart of the consumer sentiment, we can take a look at how that behaved throughout the 1970s. As inflation was rising here, you can see what was happening to consumer sentiment. It was declining in a very proportional way to how inflation was rising. The exact bottom in inflation, the trough to peak in inflation, corresponds to the peak to trough in consumer sentiment. And the same thing again, trough to peak in inflation, peak to trough in consumer sentiment. And again here between 1977 and 1980, trough to peak in inflation is peak to trough in the consumer sentiment. And you can see, in fact, if I put a vertical line here on this top in inflation in 1970, corresponds to the exact bottom in consumer sentiment in 1980. And same thing again here in 1974, right there, and again here in 1970. So if we fast forward to today and what's going on in 2022, let's bring that line here. You can see it makes sense what's been happening over the past few months. We've had rising inflation and declining consumer sentiment. It's been an inflationary fueled decline in the consumer sentiment. Now, over the past few weeks, we've made the case, the macro case, that inflation is peaking. Inflation is very likely to come down. And a big part of the reasoning for that is because motor fuel, so oil, basically oil prices, are the primary driving factor leading up to a peak in inflation, right? And you can see that leading up to the peak, oil is rising substantially, and after the peak, oil is coming down. And we've discussed this chart as well, the fact that oil has been contributing to CPI in a way that we just have not seen throughout history here. And you can even take a look at how long this inflationary cycle has lasted relative to other inflation spikes, right? June 2020 to May 2022, that's 24 months of trough to peak inflation, right? So between the beginning of the inflation spike to the top and the peak of inflation, it's been 24 months. Each inflationary cycle throughout history since the 1940s has been smaller in comparison to the one we're seeing now, except for 1973 to 1974, that also lasted 24 months. So, that tells you just from a time perspective that it would really be surprising to see inflation continue for a lot longer and not actually see it come down substantially from current levels. In fact, if we take a look at the break-even inflation rates, it seems market participants are beginning to anticipate that inflationary pressures are easing, right? And we take a look at the CPI on top of this chart. You can see we've discussed this before, but you often see these move in line with one another. And for example, in 2021, the market anticipated that we were going to see this big rise in inflation that ended up materializing a few months later. So here, we'll see if break-even inflation rates are predicting this move back down in CPI successfully. So if we are correct about this decline in inflation, then perhaps that suggests that we should see consumer sentiment move back higher again. And that type of move could bring about a lot of optimism around the economy, around spending, people having more buying power as inflation is cooling down. And a lot of the negativity that we've seen throughout the past few months that's brought the stock market down could be relieved, at least for a few months, as we get this disinflationary move. And if you take a look at how S&P 500 returns following a bottom 2% reading in consumer sentiment, and when I say bottom 2%, I'm referring to this here, right? So we took a look at the bottom 2% of readings in this consumer sentiment index, highlighted, and we calculated what were the S&P 500 returns following these readings all together. And you can see returns are absolutely massive, 2%. And these are annualized returns, just to show you that the first month is often the most powerful move, but the market continues to outperform in the months ahead. And you can see that's the case 1 month, 3 months, 6 months, all the way to 12 months out. Returns are higher when you're buying the S&P 500 when consumer sentiment is low than at any other time in history. So that is definitely something to keep in mind, and an interesting way to look at consumer sentiment. If you're buying the S&P when consumer sentiment is low, you're probably gonna do better than when you're buying when consumer sentiment is not low. Now, before we dive into that, I want to make a quick reminder that the trading room has now reopened to all members. It was closed for a few months. Because we couldn't keep up with the number of questions, and we want to make sure that we're answering all questions and that we're keeping the responses to the questions as high quality as possible. The concept of the trading room, you can literally ask any question, make chart requests on specific stocks, sectors, indices, and our job is to answer and give you the opportunities as we see on the chart and our opinion on how we think it looks. It's also a great place to interact with like-minded investors, ask questions about our macro outlook, our investment thesis, our trade ideas. We are available on the trading room throughout the trading day. So if you are interested in that kind of service, make sure to go and check it out. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, click on that subscribe button if you are new here. Now, in the meantime, I wish you good luck on your trading and see you next time.